You would have noticed that mutual funds change their total expense ratio or TER from time to time. If the TER reduces, investors are happy and they do nothing. If the TER increases, investors feel cheated and generally use Twitter to take it out on the AMC. And then there is the third kind of reaction, which is more of frustration and happens when you see your mailbox flooded with emails notifying you of a 0.01% change in the expense ratio. Hi everyone, my name is Shankar Nath, and in this video we shall go a little deeper into understanding the total expense ratio in mutual funds and present some reasons and observations on why AMCs change the TER so frequently. The SEBI guidelines clearly define the maximum expense ratio that can be charged to a scheme. And this maximum expense ratio keeps coming down as the size of the portfolio increases. So while the highest limit allowed for an equity scheme is 2.25% for a small AUM fund, for equity schemes with an AUM of 50,000 crores or more, the highest they can go is 1.05%. This slab structure was introduced from 1st of April 2019, which meant a number of schemes had to fall in line and ensure that they keep their expense ratios within the regulations. The SEBI change has mostly benefited Indian investors who now pay a lot less expense ratio than previously. In fact, we did a study on the top 25 equity funds in the country and saw that on an average, the expense ratio of the direct plans had dropped by 0.3% from where they were before the SEBI mandated changes. More importantly, and ceteris paribus, a 0.3% drop in expense ratio automatically means a 0.3% improvement in returns from these schemes. The first reason why mutual funds change their total expense ratio relates to changes in the AUM or the assets under management. In the previous section of this video, we understood the importance of AUM to the calculation of the total expense ratio. For instance, let's assume a scheme has an AUM of 800 crores. In this case, and according to the AUM slabs, a maximum expense of 2.25% is applied on the first 500 crores, then 2% is applied on the next 250 crores, and then 1.75% is applied on the rest 50 crores. This totals to a weighted expense ratio of 2.14%, which is the maximum that this equity fund can charge. Now let's say the stock markets tank and the AUM of this fund drops to 700 crores. This would prompt a change in the calculations, and the TER, which was earlier 2.14%, would now go up to 2.18%. This movement of AUM happens every day. However, since changing the expense ratio on a daily basis is highly impractical, most AMCs change TERs on a monthly or quarterly basis. A second reason for these changing TERs is to do with the rising competition amongst AMCs for the investors' money. To put competition in numbers, there are presently 39 ELSS schemes to choose from. There are 33 large cap funds, 28 mid cap funds, 30 flexi cap funds, and an army of index funds for consumers to choose from. Additionally, there is a big expectation factor, and consumers often move from one scheme to another if the performance does not keep pace. We know by now that returns and expenses are largely part of the same equation, which means fund houses have to be careful on how they price their schemes. A high expense ratio might mean lower growth in AUM or even negative AUM as compared to others, and AMCs are likely to factor this in their calculations and strategies. A related technique often used by fund houses is to keep a low TER when the scheme is new so that more investors are attracted to that scheme, and once the AUM has grown enough, they then push up the TER to compensate for the initial lower expense ratio. Now, investors don't like this. In fact, we don't like this. But mutual fund companies justify sudden expense ratio hikes under the pretext that the TER falls within the SEBI prescribed limit. So this is certainly a growing issue, and hopefully the SEBI will look at it in the future. And there are some interesting examples that the SEBI can borrow from. For instance, the insurance regulator IRDAI ensures that all insurance companies have to get any changes to their premium justified and approved from the regulator before making any changes. This might be a tad difficult in mutual funds with thousands of schemes, but yes, an acceptable approach would be needed. If you can think of an approach that keeps the investors and the mutual fund companies' interests in mind, then do let us know in the comments section below. And if you haven't done that yet, do subscribe to the ETMONEY YouTube channel and share this video with your friends and connections over Facebook and WhatsApp. In the first week of April, many HDFC and UTI mutual fund investors received a note that these AMCs would be hiking the TER in some specific index funds. While a change in TER is pretty common for an actively managed fund, investors tend to be more sensitive to TER changes in an index fund. It also did not help that the three schemes where the TERs were increasing happened to be the top three index funds in India in terms of AUM. HDFC's Nifty 50 index fund and the Sensex fund had an expense ratio of 0.1% for the direct plans, which as of 15th of April is 0.2%. And the UTI Nifty index fund's direct plan TER goes up from 0.1% to 0.18% from 16th April onwards. Now we were curious to understand why HDFC and UTI would hike 8 to 10 basis points, especially at a time when many other AMCs were aggressively launching their own index funds. For this, we spoke to three different AMCs and it seems there is a pricing issue here. Let me explain. The simplified cost of running a Nifty 50 index scheme is anywhere from 8 to 12 basis points, that's 0.08% to 0.12%. So there are the RT&A costs, the custodian expenses, the trading fees, the GST, etc. that are all attributable to an index fund. Plus, when we apply the additional 2 basis points that has to be kept aside for investor awareness programs, that previous 0.1% TER starts looking like a steal. And while it might be a steal for the investor, for the AMC, it smells more like a loss. So then the question is, what was happening all this while? What we think was happening is that the active funds had been subsidizing the index funds for the last many years under the hope that the index funds would gain huge volumes and would be able to operate on their own. And while there is growing warmth towards index funds and index funds are definitely catching people's imagination, it seems still a few years away from being the predominant investing vehicle from an AUM perspective. The other theory we had, and this too is related to the economics of running a fund, is the change in accountability for both these asset management companies. After all, unlike a lot of other AMCs, HDFC and UTI are listed on the Indian Stock Exchange, which might not allow them their previous flexibility of cross-subsidizing one fund with the other. Again, all this is conjecture and we are purely trying to read between the lines here. But if we focus on just the economic argument, presently the cost of running an index fund seems to be 9, 10, 11 or 12 basis points, and if these guys are charging 0.18% or 0.2%, then they are working at a profit margin of around 0.08%, which comes to about 800 rupees for every 1 lakh invested in a mutual fund. Again, this is what our research has put forward, but if you have any other information that adds more light to this, then do add it to the comments box for everyone's consideration. Most investors understand the services and the value add provided by the asset management companies and why an expense ratio is needed to be paid. In our view, what irks most investors is where the TER is decreased with the sole purpose of increasing the AUM and is then increased at a time when the investor can't redeem their units without incurring exit load and capital gain taxes. And unless AMCs become more morally self-regulating, we think there is a case for SEBI to step in with solutions which are acceptable to both parties. These can include simple conditions like allowing a TER increase only once or twice in a financial year, or maybe regulating the quantum of increase like a rise of not more than 10 basis points per iteration, or maybe an approval process where AMCs must disclose the reason for the TER change to SEBI, or perhaps allowing investors to exit the scheme without any exit load if there has been a significant hike in the TER. The point is, a lot can be done to ensure that AMCs don't start weaponizing the TER changes, leaving investors in bad taste. Overall, we think there are going to be some more ad hoc changes in expense structures, especially with index funds TERs, with some expense ratios going up while some others going down. But when the dust settles, index funds would have found a sweet spot somewhere between 15 to 20 basis points, especially for the large cap index funds. That's our prediction, and only time will tell how it works out. And with this, we come to the end of this video. If you like this presentation, then do subscribe to the ETMONEY YouTube channel and help us spread the good word by sharing it over WhatsApp, Facebook, and Twitter with your friends and connections. Thank you for your time, and we look forward to catching up with you next week with another insightful video. Until then.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.